Picture this. You open your paycheck next month and see an extra $150. Not bad, right? Maybe you splurge on that dinner out you've been postponing. But then reality hits. You're at the grocery store and milk costs $1 more. Your mortgage rate just jumped. And somewhere in Washington, a debt clock is spinning faster than ever. That $150, it suddenly feels like a mirage. On July 4th, 2025, President Trump signed what he called the One Big Beautiful Bill Act, the OBBBA. Beautiful name, massive implications. The Congressional Budget Office wasn't quite as poetic. Their estimate? This bill could add over $3 trillion to our national debt. That's trillion, with a T. Here's the question keeping financial advisors up at night. Did this bill actually help your wallet, or did it just mortgage your future? If you're between 24 and 55, in your peak earning years, maybe saving for a house, raising kids, planning retirement, this bill affects you more than any other group. Today, we're breaking down what's actually in this massive bill, who wins and who loses. Spoiler, it's not what you think. The hidden inflation time bomb nobody's talking about. And most importantly, your 4-step action plan to protect your money. This isn't political commentary. This is your money. Let's get into it. Let's start with taxes, because that's where most people will feel this first. Remember the 2017 tax cuts? OBBBA makes them permanent. No more wondering if they'll expire. But here's where it gets interesting. Corporate tax rate dropped from 21% to 18%. That's a massive cut for big business. For regular folks like you and me, there's a bigger standard deduction. That's good news if you don't itemize. You might also get breaks on tips, overtime pay, and even auto loans. But, and this is crucial, many of those itemized deductions middle-class families depend on. They're shrinking or disappearing. Think about it. If you've been deducting mortgage interest, state taxes, medical expenses, you need to run the numbers now, not in April. For some families, this could mean paying more, not less. So where's all this money coming from? Short answer, it's not. Congress raised the debt ceiling by $5 trillion. They're essentially putting this on America's credit card. Now, there are some new tariff revenues coming in, taxes on imported goods, but they don't come close to covering the cost. Not even close. The bill funds major increases in defense spending and border enforcement. The Republican argument, this investment will spark economic growth that pays for itself. The question economists are debating, has that ever actually worked at this scale? Here's the part that gets uncomfortable. Every dollar has to come from somewhere. OBBBA cuts funding for Medicaid, healthcare for lower-income Americans, food assistance programs, green energy initiatives, higher education support. In essence, this bill trades permanent corporate tax relief for reduced public safety nets. Whether you think that's good policy or bad policy depends on your economic philosophy. But the math is clear. Corporations win big, social programs lose big, and middle-class families, you're somewhere in between, trying to figure out which side you're on. Let's talk about the elephant in the room. $3 trillion in new debt. This isn't partisan fear-mongering. The Congressional Budget Office, the Brookings Institution, the Peterson Foundation, these are the most respected fiscal watchdogs in America, and they all agree, this debt trajectory is dangerous. Here's why it matters to you. When the government borrows trillions, they have to pay interest. Currently, we're paying over $600 billion per year just in interest on existing debt. This bill could push that past $1 trillion annually. That's money that can't go to infrastructure, education, or yes, lowering your taxes. But there's a more immediate threat. Inflation. Think of the economy like a bathtub. This bill is turning on both faucets at once. Tax cuts put more money in people's pockets, and government spending pumps more money into the economy. More money chasing the same amount of goods? Prices go up. Economics 101. But wait. There's a second inflation trigger nobody's talking about enough. Tariffs. Those new taxes on imported goods. Companies don't just eat that cost. They pass it on to you. Your electronics, your clothes, your car parts, all more expensive. Here's where it gets personal. When the government borrows $3 trillion, they're competing with you for money. Banks, investors, lenders, they all have finite resources. The result? Upward pressure on interest rates. This means your mortgage rate stays high or goes higher. That car loan you were considering, more expensive. Credit card rates, through the roof. Business loans for that side hustle, harder to get. Remember that $150 boost on your paycheck? If your mortgage payment goes up $200 because rates climbed, you're actually losing money. So how does this compare to the Biden approach? Biden focused on targeted stimulus and social programs. Basically, spend on specific things to help specific groups. The OBBBA is the opposite philosophy. Broad tax cuts, especially for corporations, hoping it trickles down through economic growth. Compared to Trump's own 2017 tax cuts, this bill is bigger, more permanent, and, according to most analysts, more tilted toward the wealthy. Let's be honest about who benefits most. The top 0.1%, we're talking ultra-wealthy private jet money. They're looking at an average of $309,000 per year in tax savings. Combined with expanded estate and gift tax breaks, generational wealth just got a massive advantage. Corporations with that 18% rate, they're celebrating. Shareholders are celebrating. C-suite executives with stock options, they're definitely celebrating. Now let's talk about you, the 24 to 55 crowd, working full-time, trying to build something. You'll probably see some benefit from the standard deduction increase. If you work overtime or earn tips, those new exemptions might help. Maybe you save $1,200 a year, maybe $2,500 if you're lucky. But here's the catch, and this is critical. Risk 1. You might lose more in itemized deductions than you gain in standard deduction. Run the numbers. Risk 2. If you or a family member relies on Medicaid, or if you're close to the income threshold, those program cuts could cost you thousands in healthcare expenses. So you saved $1,500 on taxes but lost $3,000 in healthcare support. That's not winning, that's losing with extra steps. Imagine you're a nurse, age 38, with 2 kids. Your paycheck looks slightly better, but your hospital just lost Medicaid funding, hours are being cut, and your elderly parent no longer qualifies for the assistance they needed. The math doesn't add up. This bill also reshapes entire industries, which means your job security might be shifting. Who's hiring? Defense contractors, massive new spending, traditional energy, oil, gas, coal, infrastructure and construction, legacy manufacturing, protected by tariffs. Who's cutting? Renewable energy, solar, wind companies, healthcare providers dependent on Medicaid, higher education institutions, tech sectors relying on government grants. If you work in a losing sector, this isn't cause for panic, but it is a signal to diversify your skills, update your resume, and maybe start networking. Job security just got more uncertain. So how did Wall Street react? Stocks rallied hard. Lower corporate taxes mean higher profits, which means higher stock prices. If you have a 401k, you probably saw some nice gains. But the bond market, where the smart money often goes, tells a different story. Bond traders see that massive debt load and get nervous. They're worried about future interest costs and inflation. The scariest question, what happens to America's credit rating? If rating agencies downgrade U.S. debt, which some analysts think is inevitable at this pace, borrowing costs go up for everyone, the government, businesses, and yes, you with your mortgage. This isn't just an American bill, it's a global statement. Those new tariffs? They're aimed primarily at China and other trading partners. The goal is to bring manufacturing back to America and strengthen domestic industry. The risk? Trade wars. When we put tariffs on Chinese goods, China retaliates with tariffs on American exports. Farmers, manufacturers, tech companies, they all get caught in the crossfire, and ultimately, you pay for it at the checkout counter. This uncertainty is why you're seeing increased interest in alternative assets. Gold prices have been climbing. Some investors are looking at cryptocurrencies as a hedge against dollar instability. I'm not recommending any of these. But I am saying the smart money is looking for shelter. That tells you something about how serious this fiscal situation is. Alright, enough doom and gloom. Let's talk about what you can actually do about this. You're in your prime earning years. You have time to adapt. Here's your action plan. Action item: review your tax strategy this month, not next April. Sit down with your W-2, your deductions, and a calculator. Or better yet, book an hour with a CPA. Ask yourself, am I better off with a new standard deduction or itemizing? Do those tip overtime exemptions apply to me? Did I lose deductions that outweigh my gains? If you have a side hustle or small business, the new expensing rules could save you thousands, but only if you know they exist and how to use them. Do this before June. Don't leave money on the table. Action item: rebalance your portfolio with inflation in mind. Cash loses value during inflation. Bonds struggle. So where should you be? Consider equities in defensive sectors, defense contractors, traditional energy, infrastructure companies benefiting from the bill. Commodities. Gold has historically been an inflation hedge. Tips: Treasury inflation. Protected securities adjust with inflation. Real assets. Real estate can appreciate with inflation, though watch those interest rates. I'm not giving financial advice. I'm not your advisor. But talk to yours about shifting from cash-heavy positions to inflation-resistant assets. Action item: attack high-interest debt now. Lock in rates where you can. If rates are going up, and most economists think they are, this is your window. Refinancing? Do it now if you have equity and can get a decent rate. Car purchase? If you were planning to buy in the next year, consider accelerating. Credit card debt? Pay this down aggressively. Rates are only going higher. Focus on the highest interest debt first. Every dollar you pay down now saves you multiples when rates climb. And build that emergency fund. Economic uncertainty means job uncertainty. 3 to 6 months of expenses in a high-yield savings account is your safety net. Action item: review your benefits and healthcare coverage immediately. If anyone in your family is on or near Medicaid eligibility, check your state's new guidelines. Program cuts are rolling out differently state by state. Losing healthcare coverage can cost you $5,000 to $15,000 per year per person. Your modest tax cut won't cover that. Look into employer health insurance options, healthcare marketplace plans, HSA contributions, triple tax advantaged. Also review food assistance, child care subsidies, student loan programs. Anything government funded that you or your family relies on might be changing. Don't wait for the letter telling you your benefits are cut. Be proactive. So here's the truth about the OBBBA. It's a $3 trillion bet on supply-side economics. The idea that if you cut taxes on corporations and the wealthy, growth will follow and lift everyone. Sometimes that works, sometimes it doesn't. The data is mixed at best. What's certain is this: short-term stock gains and modest tax cuts for some, paid for by massive debt, program cuts, and long-term fiscal risk. If you're 24 to 55, you're going to live with the consequences of this bill for decades. You'll be paying this debt down, or your kids will, but you're not powerless. Review your taxes, hedge against inflation, manage your debt, protect your safety net. The best financial defense is staying informed and adapting quickly. What's your biggest concern about this bill? Drop it in the comments. I read every one, and I'll try to answer the most common questions in next week's video. And if this breakdown helped you understand what's actually happening with your money, hit that subscribe button. We break down economic policy without the political BS every single week. Stay informed, stay prepared. I'll see you next time.